So here's sort of a recipe, if you will, for finding calendar candidates. First of all, we want to sell about 25 to 30 days of time premium. Now, the reason we don't want to sell more is simply because remember the time decay of options. Remember how it accelerates as we get closer to expiration. That last 30 days is when it is decaying the most rapidly. And so that's why we want to sell options at about 30 days, because that way we're going to make our money faster. Because basically, how we're making our money with the calendar spread is the time decay on that front month option that only has 30 days to go is much more rapid. So it's losing money faster than the time decay in the option we own out 1 or 2 months. And so that's the basic principle that we're using to make money on this trade. Now, the next step is very important, critically important. Check the current implied volatility level of the stock that you're going to trade, that you're thinking about, and then look at its history and just ask yourself, what's the lowest that IV has been for this stock in the past, and what's the highest it's been in the past, and where is it now relative to that? Bottom line is you want implied volatility to be toward the bottom end of its history. Let's take a stock like Google. Google, probably the lowest IV ever gets is about 23%. Right before an earnings announcement, the at-the-money options will have IV of maybe 115, 120%. So that's the range, roughly 23 to say 115. If I look at Google today and volatility is at 60%, then I'm sort of up there in the middle of the range. And that's not a good idea, because that should tell you that volatility could come down as easily as go up. And we don't want to risk volatility dropping while we're in this trade. If, on the other hand, I went out and checked IV for Google and it was at 30%, then I'd say, okay, we've passed that test and we can go on and evaluate calendar spreads on Google because it's in a lower portion of its historical range. What that means in practice is simply that the probabilities then are better that volatility will go up rather than go down, and that's what we want. Next, don't trade a negative skew. Watch your positive skew. If it's large, like we mentioned earlier, then you need to know why. You need to go out and do your homework. Also, compute one standard deviation for 30 days and just look back at the price chart and just ask yourself, has it made this large a move once or twice or frequently? Let's say one standard deviation is $20. Then go back and look and see how quickly does this stock move $20 up or down. If you're seeing a lot of one standard deviation moves, then that tells you that this is going to be a little more dangerous candidate for a counter spread. The other thing you want to check on is whether you have any big events like earnings announcements coming up in the future, because that would cause a big price move. You don't want that. Now, another factor that we're going to run into when we talk about selling calendar spread or buying calendar spreads rather on a low volatility stock, something conservative like an IBM or a General Electric, what we're going to find is that there's not much premium in the options. So in those cases, we need to be careful that we're always selling at least 40 cents of time premium in that front month option. Otherwise, it just doesn't make much sense. We should move on to another candidate. You're going to have to use some kind of options analysis software to calculate your break-even prices, but you are going to need your break-even prices because that's how we're going to manage this trade. Now, any of your broker's websites will have that software so that you can do that. You don't need a separate package. The package that I use commonly is separate, and it's called Platinum, but you can also buy Option View. That's another competitor of Platinum. But most of your brokers nowadays really have tools that are almost as good on the website for free. Now, we can do this with, like I said before, low volatility conservative blue chip stocks. But the problem there is that we're not selling very much premium. And so then we typically end up using a large number of contracts. And that's where the trading commissions become a factor. If I'm doing a calendar spread with 10 contracts, trading commissions may not be that big a deal. But if I'm doing calendar spread with 100 contracts, then it may be a large portion of my profit. On the other hand, when I use higher IV stocks like the Googles of the world, I get a nice profit because I'm selling high premium, but I have more risk of the underlying stock moving faster up or down. So that's the downside.